Hi, welcome to my channel. How are you? Everything's good? Okay, the topic for today's discussion is PPE, which accounting standard IAS 16, which is a property, plant and equipment. We will discuss about ins and out of this standard. So what exactly IAS 16 is? The property, plant or equipment which is with you, which you held for more than 12 months. So if you have a plant or property or any equipment, any machine which you're gonna use in your business for more than 12 months, so that will gonna be your asset. So you can consider that as an asset, so you can capitalize it. So this will cover under IAS 16. Okay, now we will do some more theoretical things. So there are two, as per the book, the recognition criteria. Recognition criteria is if you feel if there is economic future benefit will flow towards the entity. If the because of this asset the economic benefits will flow towards the entity. And the second criteria is the cost of asset can be measured reliably. So these two are criteria. If because of this asset you can expect economic benefits will flow towards the entity, so it means you're gonna get the benefits.
Bring my phone. Bring my phone.
So if the economic benefits you're gonna get, so it will give you the economic benefit. The benefit could be uh, in money, it could be in efficiency, it could be in anything. So you will recognize this as asset, you will capitalize this. And the cost of the asset can be measured reliably. It means the cost can be measured. It is not like that you have some asset that you cannot figure out the cost. If the cost cannot be measured, you cannot consider it as asset. For this you have to have cost have to be realized. Okay, so if you have these two then only you can get it. But I'll give you the example, like if you have a plant, if you have a car, if you have a building, then you can consider it as your PPE, as your asset, as your it will cover under IAS 16. If you have car or building or property or machine for business use, it will cover under IAS 16. We will put IAS 16 on it. So car, building and machine for business use will be covered under IAS 16. And if and if it will cover under IAS 16. But if you have a cars and you are selling those cars and to get the money, to get the profit, so if it is your ordinary course of business is selling cars or selling buildings or plants, then we cannot it cannot be covered under IAS 16. We cannot put IAS 16 for them. So these will be, because this is your inventory, so we will these will cover under IAS 2. If you're selling cars or buildings or plants is not for the business use, you have keeping it to sell it, so we will consider them as your inventory, so it will cover under IAS 2. So if I say capitalize this, it means we need to consider it as asset, and we will put IAS 16 on it. And if I say no, do not capitalize it, it means just expense this out. So you can take all this under expense it out, and you can take it to your profit and loss. The initial measurement. What things to be added in the cost? The cost or list price itself, cost or purchase price, or list price. Okay. Cash discount. Cash discount, you will not deduct cash discount from this, from the cost of the asset, from the asset cost. Because the cash discount was given to you on early payments or late payments or any in between the periods, any decided period. If they say if you pay within 25 days, then if you, like, if I give you example, if there is a business and they are having a credit terms with each other, then they offer him, if you pay this invoice within 25 days instead of 60 days, I will give you the discount, 20% discount. So that cash discount, you will not deduct this from the cost, but you can deduct trade discount. If you have any trade discount, you can deduct. So let's trade discount. What other cost you will add in the initial cost of the asset is import duty, import or custom duty. It is for those assets which is coming out from the country. Like if you have imported a machine which is not being produced in Pakistan, which is not being available in Pakistan, so you imported that plant or machinery from other country, like from USA. So once they because of the custom service, they will not let this machine off until you paid. Like Lamborghini is not being, or Audi, because they are not, these cars are not manufactured within Pakistan. So if you want to have a Lamborghini, so you need to import it from outside. Same goes for iPhone, because iPhone mobile is not being developed or produced within Pakistan. So if someone wants to buy an iPhone, he has to go out the country and get the phone and come back. And the same goes for Lamborghini. If you imported the car, they will give you the import duty or custom duties. You have to pay those custom duties, and you can include these duties in the initial cost of the asset. Same goes for transportation cost. Like if the asset is too big, if you have bought a plant, big plant for your, or big machine for your business, then you have to pay transportation costs, because anything to bring that asset to work, any cost which you put to bring the asset into work, whether it is transportation, whether it is on working condition, every cost you can add in this initial cost. Insurance. in transit only. Like if you say that some assets are too delicate, so you put insurance on it. So if it is developed, if it is got damaged, then it must be covered by the insurance. So that some assets are too fragile or too easy to break or too easy to get damaged, so you, in order to secure them, you insure them. That insurance in transit you can add in the initial cost. Then is installation cost. Like you install something, then it costs you more. Like you have a plant, then you need to spend 100,000 to install this device or the plant. That expense you can include in it. Any professional fees, accountancy fees, anything in it. And the last one is compulsory disposal cost. Compulsory disposal cost, I will let you know by end of the lecture. I will do some question on this, so just leave it for the time being. I'll just give you that like a full idea. Compulsory disposal cost or decommissioning cost. It means if you want to get the oil out of the land from the sea, so you will be like, I want to start a business, oil rig factory or oil refinery factory. You said, I want to I want to get the oil out of the earth core. So you put a big plant inside the sea, so you are destroying the sea surface to get into the oil. So if you're done, if you say after 20 years, you can expect that after 20 years there will be no oil in from this area. So you need to dismantle all the plant. So this cost will be in this tab. So it means any decommissioning, any dismantling cost, any, because you are destroying the surface by putting the plant in. Once you finish with your project, you need to put your plant back off from the land, because the land was being damaged. So you need to restore that land too. So you need to spend more money to restore the land. And we have already studied whatever expense you gonna get, you gonna expense after 12 months. You have to record that expense within the as per their present value. You cannot like if you say, if because of the more than 12 months, suppose if you have 20 years of project, so after 20 years you have to dismantle it. So that dismantling cost and restoring the land cost will be recorded on the present value of their future cash flow. Okay, let's see, we'll do some examples now. And from here I'll tell you, if you have a property for rent, if you give the property for rent, if you have a property and you have given it for the rent, you cannot it cannot be covered under IAS 16. It will be covered under IAS 40, investment properties. We will I will record lecture for IAS 40 as well later. Okay, now let's start subsequent measurement. Initial we have done already, now the subsequent. um, First thing, training costs cannot be capitalized. Expense, if you do some expense on training cost, if you have spent million or 100,000 on training or staff training how to operate the machine, so you cannot capitalize this expense. The reason being is you do not have any control over the employees. So because you do not have the control over them, because they can leave you in any way. They can leave you, they can die, they can leave you in the next day. Once, like, for me, suppose if I have a chartered accounting firm and I'm spending my like few if I have a chartered accountant firm, or if I have a business or a machine, so I need to give training to my employees how to operate that machine. So I'm spending, suppose if I spent 100,000 on training, so I cannot capitalize that 100,000 because I do not have any control over the employees. They are working for me now today, they are working for me today, like on suppose 100,000, 100 suppose 100 pounds a day, but tomorrow they find another job with a good price, they will leave me. So I do not have any right on them, I do not have any control on them. That is why we cannot capitalize our training cost. What cost can be capitalized? Cost to capitalized, or the cost which can be capitalized. There are three scenarios, three costs can be capitalized. Cost which can be capitalized. One, if you spend something, if you spend something on which will increase their useful life, increase in useful life. Suppose you have a machine, it was having a 10 years life before, and you install a new machine part in it, and it gives you more life, like instead of 10 years now you can run that machine for say 12 years. So it means you got 2 year extra life. It means because of this expense the useful life has been increased, so you can capitalize that expense. Second, which the expense which increase in efficiency or quality or quantity, both. Uh, if like you have a machine, big machine, it was working fine, okay, but it was producing 100 unit before, okay, and you install a new part in it, you install once a new part in it, and after installation it start giving you 150 units. So it means because of this expense the efficiency and the quality and the quantity has been increased. because because of this expense the economic benefit uh, flow towards that entity, so you can capitalize this expense. Third example, third thing, the cost which decrease in operating cost. Like you were having a machine before, 10 people were required to operate a machine, okay, but because of this expense now you just need 2 people, because you put some automatic part in it, so it start working automatically. So instead of 10 people now only 2 people are required to operate the machine. It means you have saved 8 people salary. It means you have saved 8 people salary. It means the decrease in operating cost is economic benefit. So this expense you can capitalize. Let's do a few examples. Okay, let's discuss this question. Company bought non-current asset for $10,000. Company bought $10,000 non-current asset. The life of the asset was 5 years. Previously, at the end of the year two, at end of year two, at end of year two, company did subsequent expense of 6,000. This increases the life of the asset to 6 years. Previously it was 5 years, now it is 6 years. 1 year extra. You go 1 year extra. It means the economic benefit, it is an economic benefit you got the because of this expense. The life has been increased, so you can capitalize this. This is the formula for depreciation. How you calculate depreciation? Cost minus any scrap value divided by remaining life. So for 1 year, how many the how you can calculate depreciation you can calculate this way: 10,000. Do we have any scrap value? No. Divide minus 0 divided by how many years? 5 years. So it means 2,000 was your depreciation for year 1. Year 2 again depreciation is 2,000. Net book value for at the end of year 2 is 10,000 was cost. Year 1 depreciation for year 1 was 2,000. Then year 2 depreciation, so it means you are left with 6,000. It means the net book value at end of year 2 is 6,000. Now in the question it clearly shows at end of year 2 you did subsequent expense and increases the life. 6,000 you expense, 6,000 more you spend. Subsequent expense is, it means now the cost is 12,000. So previously the net book value was 6,000 and you have spent 6,000 here, so you need to spend 6,000. You can add this here. So now the cost you can consider is 12,000. And now for the next year, how you can calculate the depreciation? For the next year you can calculate depreciation for this 3. For this period, for year 3, depreciation is 12,000, this 12,000 divided by number of years. So previously it was 5 years, now it's 6 years. Okay, 6 years. And how many you have used already? 1, and year 2 you have used 2 years. Total life 6 years, used 2 years. How many remaining life is? Remaining life is 4 years. Now you can consider 3000. NBV at year 3 is 12,000. This 12,000 minus 12,000 minus 3,000. So 9,000 is NBV at end of year 3. Okay. Okay, let's do this equation now. Company bought non-current asset for 20,000. Cost is 20,000. Life of the asset was 10,000. And you have you did some subsequent expense at end of the year 3. Okay. So first you can calculate 3 years. Cost was 20,000. Depreciation, how you can calculate depreciation? 20,000 divided by life is 10 years, this means 2,000 depreciation per year. So depreciation year 1 is 2,000, year 2 2,000 again, year 3 2,000, and how many is there now? 14,000 left. Okay, now as per the question, it says at end of year 3, at end of year 3 you have 20 subsequent expense for 21,000. Now total cost, the NBV is 35,000. For this depreciation, you need to calculate depreciation for this. So depreciation you can calculate in, let me use this color, new cost was 35,000. And what is the life? 10 years was the life. 10 years life. Okay, how many you have used? 1, 2 and 3. So it means 3 year used. How many remaining life? 7 years. Year remaining. So 7. It means 5,000 is your new depreciation. In this year, the new depreciation is 5,000. So it means 30,000 gonna be the NBV. If you feel like I'm going fast enough, and then you can pause the video, you can go back and listen the same lecture over again. Okay, so let's do this equation. Company bought a car for 40,000. Company bought this car for 40,000. The life was 5 years. And there was an accident of this car at end of year 2. And you spent repair cost 4,000 to repair it. So you can do this. Cost was 40,000. Depreciation was, how you can calculate 40,000 cost divide minus scrap value, we don't have any scrap value, divided by number of life years remaining 5. So you can say 8,000 for year 1, for year 2 8,000. So by end of year 2, you can say the cost, the remaining NBV was 24,000. Okay, and now you have spent 4,000 as an repair cost. So you can ask yourself, did this give us any economic benefit? Does it increases the life? No. In fact, the accident reduces the life? No. Or any other economic benefit? No. Then the repair cost will you can expense this out. So year 2, profit and loss, we can make a profit and loss year end year 2. So two things will go, this cost depreciation, you need to expense this depreciation, and 4,000 the repair cost, this one. This will go to profit and loss for year 2. Now year 3 came in. Year 3, The total cost was 40,000 before. So because it reduces our life to 4 years. So you can consider, uh, I can calculate here. So the remaining life was 5 years before, 5 years. Then due to the accident, it reduces the value, reduced by accident. Now remaining is 4, and you have already used 1 and 2. So 5 years was the life, and because of the accident, 1 was reduced, 1 year was being lost. So you got 4. Out of this 4, you have used 2. 2 years you have used already. So the remaining life is 2 years. So divided by 2. I can highlight this with this. Okay. So remaining life is 2. So after dividing 24,000, so the NBV was 24,000, and now you have 2 years life. So it means 12,000. The new depreciation is 12,000. So this will be the NBV for at end of the year 3. At end of year 3. In the year 3 profit and loss, depreciation expense will go. Depreciation expense was 12,000. Now we will discuss about the measurement models. There are two different models. One is the cost model and one is revaluation model. Either we can use a cost model for our property, plant and equipment, or we can use revaluation model. So previously, before the standard, the director was doing this. Like if you have a land with the cost of 100 million, and at the year first you have this land with you. After 1 year, the market value of this land has been increased to 215 million. So you got gain of 150 million gain. The director was very happy. So he was like, oh yeah, let's start using revaluation model. And then in the next year, the market value was being reduced by like it is reduced to $60 million. The actual cost was 100, but the new market value at the year 2 has been decreased to 60. It means from 250 to 60 there was a huge and massive loss. The director was like, no, 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 we were, you know, we let's start calculating as per the cost model and record as 40 loss revaluation loss. And then standard came in. Standard says no, once you have chosen one model, then you can continue using the same model. You cannot be like in 1 year you are start using on cost model, and the next year you start using revaluation model. So once you change it, keep it for the next years. And same goes for, like, there are few, if you have considered this example, if you can consider this example for another question, I'll give you one more thing. Like, if you have a property, one building in best area of, or you can say in England or in London, and you have one property in countryside near to Bolton or like cheaper areas. So you can see uh, the value, the cost value was 100 million, but at the year of one you go to 50. So the director was like, the one you have in London, it gives you increases to 250, and the one you have in Bolton and other areas, the value has been decreased. So you can, the director was, let's start using the revaluation for model for the best areas and cost model for the other areas. Or you can consider this example, like if you have a car in your business, like if you have a Mercedes and you have a Toyota. So the director chooses, let's start cost model on Toyota, or let's do the revaluation model on Lamborghini or good cars. So the stand on this point, the standard says no. For one group of assets, if you have one model for one group of asset, then you cannot have the other model for the cars. So if you, the group of asset is cars, so you can only use cost model for, not for only one car, for all the other cars. If you are using revaluation model for one car, use the revaluation model for the rest of your cars. Or if you have if you are using a cost model for your one property, then use the cost model for all other properties, even if the property was in London or was in Bolton or Birmingham, wherever. If you are using revaluation model, then you use one model for all other assets, for all properties, for all the cars, group of assets. You can keep on changing. Okay, let's discuss revaluation. Revaluation model for non-depreciating asset. Like land. Land is a non-depreciating asset. Suppose you have a land, when you bought it the cost was 100. At end of the year 1, at end of year 1 the land value has been increased to 150 million. So it is a gain. So you got the gain. So we have already discussed this equation. You must have read this equation many time in your life. Capital is equals to net assets. Capital or equity is equal to assets minus liabilities. So in this case the assets are increasing. Once, if the assets are increasing, it means this will increases the equity. So it means the land value was increased by 50. 150 to 100 means 50 is valued by, So your property was being valued by 50, so you got the gain of 50. So the double entry would be land debit. Why you are debiting land? Because it increases your asset. Once you are increasing your asset, then it means it will increase your capital. So do not take this amount, do not credit profit and loss. You cannot consider this as your gain because it's just assumed gain. It's just a revaluation gain. It's not the original gain. The original gain will come when you actually gonna sell this property or sell this land. When you're going to sell this land, then on that gain you will have your profit. But now you cannot you cannot consider this as your income because it's not genuine. It's just assumed. It's not realizable. It's not realized. It's not realizable. So in this equation we can increase in this equation. If you increase the asset, it means it will increase your equity. So you need to credit revaluation reserve account by 50. And we have discussed when equity is increases, it credited. We will credit the liability, or we will credit the equity when it increases. So this will be your double entry. Let's do the case. This was case 1. Let's do the case 2. On day 1 you have a land. You bought a land for 100 million. At end of the year 1 you did the revaluation, and then you realized that the market value is 75. And let me tell you when to realize what standard did not say anything on it. Like it could be it could be like 3 months, it could be after 1 month, it could be after 1 year, it could be after 5 years. But you need to take that revaluation gain if it is materialistic. Like if you say your property was 100 million and it gives you just 100 pound extra, or it gives you 500 pound extra. So 100 or 500 is nothing against 1 million. So you can, if there is no materialistic change, then you cannot keep this as your on the cost model. So once you see that there is a big difference, huge difference, like 50,000 or 20,000, like huge and massive difference, you see a materialistic difference, then take it into the revaluation model. So let's discuss the land case 2. Non-depreciating asset land case number 2. You are having a asset of at a cost of 100 million at end of the year 1. You did revalue, and once you have revalued it, and then you realized it has been decreased by 25. So you can credit land directly because the land has been decreased by 25, to credit it. So it means if the asset is decreasing, then we credit the asset. So this is going to be the asset. What you gonna debit? Where you gonna put this in? So you, in this case, because as per the prudence concept, when you see any loss, consider as you can expense out this loss. So debit profit and loss. Take this to profit and loss. It means expense increases. When we increased expense, it goes to profit and loss, or it is the expense debit. It means debit means expense are increasing. That is why we are debiting it, and we are crediting the land because the asset is decreased. Okay, let's discuss another example. Non-depreciating asset. The cost was 100 million, and after end of the year one, the market value was you revalued it and you come up with 140. It means you got a gain of $40 million. So same we can do this. So land, you can debit land because the asset is increasing, so you can debit land. How much? 40 million. Here you need to credit revaluation reserve. Revaluation reserve of 40. Equity increases. Because equity is increasing, we did this entry. So land debit by 40 and you put 40 extra to reserve that you have maintained, or you started a revaluation reserve. And then the very next year you see it was being devalued by, so 140 and 80. So it means how much it is. It was devalued by 60, I guess. Yeah, it was devalued by 60. So at the end of year 2, the market value previous year was 140, but this year the market value was 80. So it means uh, you got the d value of you got the d value by the asset was the land was devalued by 60. So the standard say how we will record this entry. The land was decreasing, credit the land first. Land by 60 pound, 60 million. Land decreasing, credit. Debit. So standard says previously reverse that reserve you have before. So we have a reserve of 40 before, so reverse this reserve. So revaluation reserve, we will reverse this revaluation reserve. You are having 40 before, we were reversing it, that is why we are debiting it. So previously we credited the equity because it was increasing, now we are debiting the equity because it is decreasing now. So standard says if you have a d value, reverse the revaluation reserve before you put this into profit and loss. The remaining amount, the balance amount, you can put this into profit and loss. You can debit profit and loss because expense is increasing. You can consider this expense profit and loss of 20. So this is the way you record your double entry. Okay, let's do another question. Case number 4. So in this case we will say you have a cost of 100 million, and then at the end of the year 1 it was being devalued by 30. So the cost was 100 but the new market value is 70. So you can credit the land because it is decreasing. Credit the land by how much? $30 million. Okay, and debit profit and loss because we can take it into profit and loss account. We can consider as per prudence concept. 30 expense, increasing expense, so that is why we debited it. Okay, this is the case for year 1. In this case, now how much increased by it was increased by It was having 70 before, now it increases by 125. It means you have how much is it? Let's see, 30 30 and 55. It was increased by 55, valued by 55. In this case, how can we calculate? First, debit asset is increasing, so debit land 55. Now now the thing is, the standard says if you have any reserve, so reverse it, or you can add if you have a loss, you were having a reserve before, we reverse the reserve. In this previous question, we reverse the reserve here. See, we reverse the reserve, but here we will reverse the profit and loss. Any loss we were having before, we reverse it and include as income. So we were having a expense, we were having a loss in previous year, we will reverse this entry now. So you were having a profit and loss by 30. Is this balanced? Not. It is not balanced. The rest you can take to revaluation reserve, the equity by 25. Credit because equity is increasing. So you can see it was being valued by 55. The land was increased by 55, and profit and loss, you need to reverse this loss, here, and you increase the rest, you can take into reserve. We have done the revaluation for non-depreciating asset. Now we will do the revaluation model for depreciating asset like building. Let's do the example. If the cost was 10,000, if you have a cost of 10,000 and you have a life of 5 years, okay, how you will calculate depreciation? 10,000 before divided by how many number of life is 5. It means 2,000 depreciation for this year, and in 1 year, and year 2 depreciation is 2,000. Okay, and we can calculate here as NBV. How can we calculate? Let's do it from very basic. So the total cost was the cost was the cost was 10,000, and then depreciation for year 1 was 2,000, year 2 was 2,000. So the NBV will be 6,000. And in this question we say the market value has been increased to 14,000. Suppose we have a 14,000 as market value. Now it was being revalued by 8,000. How we will calculate this? So you can say the NBV, net book value, was 6,000, but when you go to the market, you assess this, and the market value for this building, they told you that market value was 14,000. It means you have a gain of 8,000. In this case, how we will maintain this, I will tell you. Thus, for the depreciating asset, standard says reverse all the depreciation you have before. It means we were having 2 year depreciation 1 and 2, so we will reverse all depreciation, accumulated depreciation, we will reverse it. We will reset it to 0, and it was being revalued by 8,000. You mean revaluation reserve will be 8,000. You will have 8,000 in your reserve, and because the rest you can, if it is there is no balanced, so that whichever, uh, if you have a debit side or if you have a credit side, a difference, just put the asset in it, because it was being reduced or decreased or increased by because of the building. So debit building, because it was being revalued, so that is why we are debiting the building, so it will be this. So this will be your double entry. It means first reverse all the depreciation you have, we reversed it. Second, uh, their market value, the revalued by 8,000, this is your reserve, so 8,000 reserve. And then you can put building, debit the building for this. It means 4,000 will go to the building. If I can show you the building account, let's make our building T account. Brought down value was 10,000, and you reverse all the depreciation here. When you reverse it, it will come, the closing balance will be 14,000. You can see market value and the closing balance is same, 14,000. Now you can see the closing balance of the building account is matching with market value. Let's do another example. Okay, same. The depreciation is 2,000 here and 2,000 here. So you can say cost was 10,000 before, and depreciation for year 1 2,000, year 2 2,000. You can see the net book value will be 6,000. So previously we did the gain, we were having a revaluation gain. In this question we will have a D value. So if you go to the market, when the net book value was 6,000 and you went to the market and you assess the asset, they give you 4,500 as your market value. It means it was being devalued by 1,500. That asset is being devalued by 1,500. So in this case, how you will record? Previously we were crediting equity, now we have a loss here, 1,500. So take profit and loss, debit profit and loss, 1,500, debit expense increased, because expense or loss has been increased, that is why we are debiting this, and we are debiting by 1,500. and as per the standard, reverse all the depreciation, accumulated depreciation. We reverse this 4,000, and I told you already the rest you can take towards the building or the asset. So credit the asset by 4,000, 5,500. So if I can show you the building account, T account, the brought down was 10,000. Okay, now the closing should be the market value, which is 4,500. The closing balance is 4,500, which is equivalent to the market value. The difference is 5,500, and we are taking this difference here. Okay, there are two different model of calculating depreciation. Straight line and reducing balance. There are two way of calculating depreciation. One is straight line. Straight line mean is just a number divided by number of years. If you have 10,000 cost and you have the life of 5 years, so in this case you can say 10,000 divided by 5 years will give you 2,000 depreciation. So if you have cost 10,000 and depreciation year 1 2,000, year 2 2,000, year 3 2,000, year 4 2,000, and year 5 2,000, and then you will have nil. So this is the way you can calculate straight line depreciation. And the reducing balance you can calculate like 10% is your, if you say that I have 100,000 amount of asset and I can expect 10% as per the reducing balance. So you can see 10,000, take 10% of this, which is 1,000. So the cost was 10,000 at year 1. Year 1 cost was 10,000 and depreciation was 1,000, and you have 9,000 for year 2. In year 2, as per the reducing balance, take 10% on 9,000, it is 900. So in this the cost was the net book value. The net book value previous year, the net book value was 9,000. You are having 9,000 before, and now the new depreciation for the year 2 is 900. So you can say 8,100 will be the new net book value. So this is the way you can calculate reducing balance depreciation. Remember, in the very beginning of this lecture I told you decommissioning cost, or compulsory I told you that at end of the lecture I will do this. So any cost you gonna you will have after 12 months, you need to calculate that cost as per the present value. You cannot, like I will tell you, you have to calculate the present value of that future cash flows for any liabilities, for any expense which is for more than 12 months. Okay, let's do the example. So how we will calculate present value is this is the way we calculate cash flow multiplied by 1 plus I raised to power r minus r. R will be the number of years and I will be the interest. Like if you have if you say 10,000, wait, if you say after 10 years you will get, you will spend 100,000 and interest rate is 10%. So the present value, you need to calculate the present value for this expense. So how you calculate 10,000 multiplied by 1 plus 10% minus number of a year 10. So let me change this. Instead of 10 I will write 5%, so you will not get confused. 5%. So you can say after 5 years how much you gonna give. Calculate. Let me get the calculator, I'll let you know. Or there are two other ways. There is another way is 10,000 divided by 1 plus 5%, yeah, raised to power 10. So this is the present value of future cash flow. So that after 10 years you got the amount you're gonna spend is 100,000. The present value of that amount in today's present value is 61,000. So let's do an example for this. Dismantling cost. Okay, the question is, company bought a platform 40 million, and you will have this project for 10 years. After 10 years you need to dismantle it, so it means the dismantling cost after 10 years will be 12 million, and the discount rate is 10%. So we will say here, let's do this year 1 after 10 years. So in the first day, what expense you can calculate? Platform 40 million debit, because you are increasing asset, debit. And bank, you paid bank or you paid cash 40 million. This will be your double entry. And the next day we will calculate present value, which I told you already. Present value, how you calculate? 12 million divided by 1 plus interest, which is 10%, number of year 10%, 10 years. So it means this will have 4.63 present value. So this, because of the dismantling cost, I told you already in the very beginning, you need to add this cost and you need to capitalize it. So you need to capitalize it. So take this cost along with the platform. So 40 plus 4.63, now it is okay, 4.63, and this is your liability. So liability 4.63, credit liability, that is why we are crediting it, debit. So this is your double entry. So if I am telling you this is very famous. If you how would I say, if you're discounting with the 10% interest rate, then you need to unwind that discount with the same interest, with the same amount of interest. So if we have discounted this value by 10%, then we need to unwind this with the 10%. So unwind of discount, unwinding of discount is 4.63 this, and take 10% on this, which is 463. So that closing liability would be this and this. So the closing liability would be 4.63 plus 0.463, 5.093 at end of year 1. Year 1. So you can say this is going to be your expense. So you can say expense interest expense debit with 0.463 and credit liability 0.463. At end of this year the closing liability is this. So you can say the extra, let's make a financial extracts. Profit and loss, let's take profit and loss. We will calculate depreciation, we will add depreciation and interest expense. Interest expense is this 0.463, and depreciation, how we will calculate depreciation, 40 million and this present value of 40 million, present value of this dismantling cost 4.63, so it is 44.63 divided by number of years, 10 years. So the depreciation is 4.463 your depreciation, and interest is this will go to profit and loss. This entry will go to profit and loss. And on the SOFP side, SOFP non-current asset platform at end of year 1, platform was 44.63 minus depreciation, this depreciation 4.463. The SOFP side platform will be of 40.167. And on non-current liabilities you will have this decommissioning liabilities, decommissioning cost, decommissioning liability. How much? This 5.093. So this will go to SOFP and this will go to profit and loss. So it is best if you practice more out of this. So I'll give you the overview. 40 million was before and 12 million after 10 years you're gonna spend. So because we are spending this after 12 months, so we calculate present value. Here we have calculated present value and we add this in this. When we add this, it is of this amount, this will be total, and divided by number of years. Number of years, this will give you depreciation, this depreciation for 1 year. So we have calculated the depreciation here, and the interest we have calculated from here. Thus if you are discounting with 10%, then you need to unwind that discount with the same amount of interest. So the closing balance is this. So present value of future cash flows, present value of future cash flows here, plus unwinding of discount. If you add these two, this will be a closing liability. So NCA, how we will calculate NCA for SOFP, cost minus depreciation. So this will be NBV for at end of year 1, and the current liability will be this will be. So we have completed the whole IAS 16. So you can it is best if you do practice for these standard. It's very important, and every time examiner will ask question on this. Stay tuned to my channel. Please do subscribe my channel for more videos, and it's best if you share this to other with your friends. See ya for the next time. See ya. Bye.